Welcome to the Söderberg & Partners Multinational Benefits webinar. In the next 45 minutes, we will present you two topics about managing employee benefits globally. As you may have read in the invitation, ensuring compliance with insurance regulations in different countries can be a very complex task. So consequences of non-compliance can have significant financial, legal, but also reputational implications for your company. So therefore, it's crucial to prioritize compliance to be sure that your global insurance programs meet the requirements of each country where you operate. Seeking legal advice and working closely with your insurance experts can help you to mitigate the risk associated also with non-compliance countries. And the other item on the agenda is risk pooling. For some of you, the presentation will be a refreshment, but you may get inspired of having a closer look to your pooling strategy after this webinar. But also for newcomers in this area, there's some useful information, for instance, how to get started with the pool. During this webinar, you can send your questions via the chat. Together with my colleague from Söderberg Partners Norway, Björn Kalvek, we'll be your presenters today. My name is Ron van Overhagen, consultant International Benefits at Multinational Partners.
And I'm Björn Kalvåg. I'm working as Senior Advisor Global Mobility out of Söderberg & Partners here in Oslo.
A short introduction of our organization. I'd like to show you this picture. Founded in Sweden, the company grew quickly also cross-border to a dominant position on wealth management, corporate pension and insurance in the Nordic countries. And with the acquisition of the Multinational Partners in the Netherlands, the company further expanded and the journey will continue, of course. We will start this compliance session. Over to Björn in Oslo.
Thank you, Ron. Compliance in international employee benefits programs is crucial for ensuring that an employer are operating aligned with legal and regulatory requirements in the countries where they are based. This involves understanding of local law, tailoring benefits, and maintaining transparency to reduce risk. And of course, support to local workforce. And employers may be required to pay monetary penalties if they're not operating in line with local insurance law and regulation. The amount of the penalty will depend on the legislation in the representative area and the severity of the violation. What's the definition of a global benefit program? A global benefit program refers to a comprehensive set of benefits and perks provided to employees working for a company or an organization on a global scale. It's designed to improve overall employee experience, promote job satisfaction, and attract and keep talented individuals across different countries and regions. In my world, as an insurance advisor, we are often referring to a package of insurances when we are talking about employment benefit programs. We can divide employee benefit programs in two parts when it comes to insurance. A mandatory part on one side and a voluntary one on the other side. The mandatory part is based on local law and regulation, and you must never try to bypass the local requirements. Here you need local professional expertise, and you should always engage a local insurance broker or a local legal advisor when it comes to local mandatory requirements. But why should a multinational employer establish the package as a global employee benefit program? Isn't it better to simply leave it up to the local entity to handle the local insurance themselves? And it's not so that one size fits all, meaning good local standard in one region is not necessarily good local standard in another one. A global program allows for streamlined benefits with centralized administration, processes and systems. This can simplify the management of the employee benefits, reduce the administrative burden, and make the program complete its purpose. It can also lead to cost savings by eliminating duplication and optimizing the resources. A centralized global program allows the organization to negotiate better rates and terms with the benefit provider, leading to potential cost savings. It's also enable better risk management by pooling resources and leveraging global expertise to mitigate risk associated with employee benefits. Implementing a global benefit program can help ensure compliance with local regulation and in the different countries, minimize the risk of non-compliance and the associated penalties and legal issues. Let's now focus on the right side of the table, the interesting side, the voluntary part. Here you have more freedom. Offering comprehensive and competitive insurance benefits can be a significant factor in the attracting top talent. A robust insurance package that includes health insurance, life insurance, disability insurance, and other relevant coverage can be an attractive proposition for potential employees. In the global employee benefit package you have today, is it cost effective? Global employee benefit packages can get quite pricey, especially if you are not quite sure how to find the right broker or the local provider. My advice to you is to set a budget and do your research ahead of time to make sure that the benefits you want to offer are within your means. Placing policies on a country or a regional basis marginalize the multinational compliance spread of risk and economics of scale, which typically can result in higher costs of both coverage and administration. Then what about compliance? As previously mentioned, mandatory requirements differ in every country, and the consequence of non-compliance is serious. Be sure to make your package adhere to local law so you can stand on the right side of the labor authorities wherever you hire. We will strongly recommend you to cooperate with advisors with a global overview and access to a significant network of competent local insurance brokers. We recommend a holistic approach. Central monitoring of the insurance program will enable you to evaluate your global risk profile holistically, resulting in a spread of risk and cost reduction. It's seldom that we can set up a pure master solution. It's more a combination of a master policy covering risk in the countries where that is possible and local policies where that is required. All policies, the master solution, master policy, and the local policy are synced to simplify administration, resulting in one effective date and one common billing circle. In addition to centralized monitoring and management, it's streamlined and simplified compared to the traditional country-by-country approach. So what can happen? Let's say, what if a company then pay a global life insurance policy, but the policy is not recognized as an insurance in the country where they're operating, and the insured life dies? Worst case, the employer may become financially responsible for paying the death benefit out of their own pocket. Or a more common way of doing it when this happens, and that happens from time to time, the insurance payment must be paid through the employer and forwarded to the dependents. With taxation, it will probably be taxated as a salary. If you do it correctly, it's normally tax-free. What if the insurance, the travel insurance, is non-compliant and your employee cause a damage to a third party? Is a risk that the insurance company are unable to arrange a payment to the victim. And this leads to costly legal disputes, potential settlements, and lawsuits against the employer. Within the context of the European Union, we have the 4 freedoms. Free movement of goods, service, capital, and persons. And a lot of the leading insurance companies in Europe, they have cross-border license to other European countries. So here it's possible to establish compliant master insurance programs. But again, be aware, you cannot automatically export an insurance from one country to another. You always must comply with local law and regulation. If you're operating outside Europe, the setup will depend fully on the local law and regulations in the country where you are operating. So, to a case. This is a leading technology company, and they felt it had a duty to care and responsibility, an obligation to protect its global workforce by keeping employees aware, safe, and protected. The company's global insurance program was complicated. They had different contracts, different insurers, different dates for issuing the policy. And the management was concerned about the inconsistent insurance coverage and their inability to exercise centralized control of the insurance program. They started a job together with the insurer and the insurance broker. The insurance broker analyzed its risk management and the benefit needs, the global footprint, and the employment landscape. And then the company adopted a new paradigm, a consolidated global solution with a single master policy out of Europe, and local policies was issued through the insurer's global network with one single effective date and a carefully crafted implementation process. The program included a master policy, local policies, each with locally appropriate terms and conditions and tax reporting. So, how can we help? Through our worldwide partnership with brokers all over the world, we can combine global insurance solutions with local presence and expertise. Söderberg & Partners International Senior Brokers will help you design a tailored program based upon your objectives, the company's culture, and your budget. We will conduct an annual review of your program, factoring in market, competitiveness, provide regulatory compliance checks, and ensure your program remains aligned to your need and goals. We have more than 850 local partners around the globe, broker specialists and consultants on place in nearly all countries. Through our wide geographical presence, we can service clients in every market all over the world. We believe in personal consultancy and relation. We work closely with the local insurers, and we appointing local advisors who know the risk in your industry where you are operating. Thanks, and then back to Ron.
Thank you, Björn, for telling us more about compliance things. Very, very informative. The next part will be about risk pooling. So, as a start, it's likely that you belong to a frequent flyer program, where individuals can earn dividends by booking flights with often the same airline or its affiliates. And then you save for some tickets or other money that you can earn by using the same vendor at the same time. The same principle can be applied to companies with overseas operations that are looking to find cost savings in their insured benefits programs. In these volatile economic times, every company and every client has motivation to find ways to finance benefits more cost efficiently. What's the problem? Well, the problem is that if you are a large domestic company, for instance in Denmark, with about 3,000 people, you can often get very favorable terms and conditions on your programs. So using one provider or one plan, or it's quite easy, and also as said, your conditions will be very interesting, and also the prices will be competitive. But as a manager at a company, in an international company, you will learn that if you have the same number of people but spread across other countries, that you cannot have these economies of scale. So for instance, if you buy an insurance for 50 people in Poland, the underwriting there will not consider that you are a company of 3,000. So you then begin already to start missing the advantages of being this big company. So as said, as you can see it on the slides, no advantages if you are spread around about the countries, and also for each country you have to select different providers. You have different policies, etc., etc. And as said, the global headcount is very irrelevant in the end for most of the companies. You ask them to cover their local plans for you. The concept of pooling, well, we've learned that that you lose your economies of scale when you cross border, and particularly when you are doing business in many countries. Each country requires separate contracts to be written. So that means that you have to approach all different vendors for your plans. And would it be possible, as you have with the frequent flyer program, to have one provider? Well, it is possible, and these vendors, they are known as insurance networks. So these are networks of insurers for many countries, could be 100, could be even more countries that are working closely together. And what happens is that the insurance network, they contact the global headquarters of the company. So they enter into a pooling arrangement. And what you see is then that the local plans, they can still remain in place. So UK are using their own British insurer. France, they have their own contract for insurance, and also for the other countries in the area. When the client gets eligible to receive a dividend, that is depending on the results of the contract. So in fact, risk pooling is a kind of profit sharing system. Simple system effect, because you calculate what's coming in on premium, if it's going out on cost, and that will be consolidated in the end of the year or the beginning of the next booking year. You'll see if there will be a dividend, if there will be a plus, or if there will be a loss made in the pool. That's all possible. You can put different lines of business in the pool, so it's actually considered as a bucket of risks. And so divided over many countries and many lines of business, all will consolidated together in one contract. How is that possible? You will see it on the next slide. As said, you see on the left side what happens in the contract. Let's consider it a healthcare contract in Spain, for instance. You see that the claims will be paid from the premium. The premium is the arrow from bottom to top. From the claims, everything will be paid. So the commission, local dividend, if there's a local profit-sharing system in place, insurers need to reserve for their future claims. So that's happening as well. Then insurers making their costs, their expenses, and on top of that always, of course, well, that's the aim of doing insurance business is profit for the insurance company. So that's what's happening in a normal situation. When you decide to start a pool, then you see in this column most of the things will be same. It depends together on the premium paid at the end of the year. But you see on top that something is changing. And for instance, in the upper side, you see international dividend going out to the client. So that means that insurance company take less profit, or they are okay with earning less on your contract. You see also a little bit changes in the expenses and the risk charge, and that has to do with something. Let's say the reason why partners are in such a network. So the question is, of course, why would an insurance company give away some of their margins? Well, that will be explained in the next slide. The answer is found if you take this as a simple example. You see 3 countries in the pool: the UK, France, and the Netherlands, and the net income into the pool is 400. Could be 400,000, 400, whatever, dollars, yen, whatever currency you would like, or you're working with Danish krones, Norwegian krones. You see, before the dividend will be paid out to the client, there will be first compensation for the partner in the network who had reported a loss. In this case, is that France. So you see 600 is coming in, 200 will be used to reimburse the French insurer, and the remaining 400 will go back to the client. So you see here that it works, the consolidation, as a kind of reinsurance for the provider as well. And so insurance companies, it's not only a fact of giving profits away, giving money away, but also having a kind of reinsurance, because they will be, as said, reimbursed via the pool, as long as there's money in the pool, of course. So that means also that there won't be any risk for the client to pay additional premium or to pay whatever if there's a loss in the pool. Losses can also be waived to the next year, or can be brought forward to next year, or can be waived depending on the kind of contract you have with the client, with the pooling network. This is only one reason for insurance companies to participate in a network. The other thing is that also it tends that this business pooled with an insurance company stays longer with the same insurer than it would not be in a pool. So, as we call it, the business is more sticky for the insurance company than without pooling. So 2 reasons. One is a more technical reason to participate in the pool, like in the reinsurance picture. The other one is the commercial reason, because you keep money more, contracts more in your portfolio, and you're even able to win more business from the same client if they're happy with the pool as it is. Getting started, the most important thing in starting a pool is about the renewal date of your contracts. So often it's not so easy to get all the information from your local management, but you can be easier satisfied because you don't need all the information. Important is that you ask some relevant information, so as less as possible to make a good estimation of what's possible with the client's portfolio. So the fewer data you need and you're asking, the easier to get it. And it's good to ask for each line of benefit to have some information, such as the renewal date, as we already mentioned, and but also the premium paid, the number of people that are there, and it's relevant whether it's in a pension plan or it's in a healthcare plan or in the disability plan, because all these lines come with their own risk. They can come together all in this basket of risks. But some you want to have in your basket and others you don't want to have in your basket. Renewal dates are actually the first thing you would like to learn and to know from your local management, because you may have long notice periods. So if you know that the notice period is 6 months, for instance, then you may already be too late to review the plan, because the renewal date is the moment where you can take action together with the local management and see if you can put a program in a pool or move the program to one of the members of the network, as you like. Also, getting the data, you can with that prioritize the countries you want to approach for the risk program. Because if you are present in 60 countries, it doesn't make sense to start with 40 countries. Better to start with 4 than 20 even. So check and prioritize, and your consultant can help you, of course, with the prioritization. And also knowing the current carrier of the program is important, because it could be possible that your provider, for instance, in Italy, is a member of a network, which means that you can put your program in a new pool, but with existing business, as we call it, the natural pool. So if you find business in Italy, for instance, in the UK, Ireland, and Canada, you can start, as we call it, a natural pool, and from there, starting and expanding the pool. If it's difficult to collect the right data, you see our name there in this kind of central position. You can ask your own management, of course, local management, to provide all this information. But SAP can do the same for you through the other line, which is the network. So we can ask for you the networks that are in the market. Can you check your books on business with client XI, XY, Z? And from there we can also make the other, let's say, analysis, seeing what renewal dates are. They're normally given, and if it makes sense to talk about a natural pool. If you have already a pool, first and foremost, it's a cost savings initiative. So it's about getting money back at the end of the year, in the next calendar year, for instance, and see if you can also grow the pool. There are a couple of things to be made here. One is important where you start a pool, where you have started the pool, that your local country managers are informed. You need them because they need to realize why you need information, and they should be informed about the possibilities, the possible advantages of doing a pool. So communication with your local people on the ground is very, very relevant. Another thing is that you can, in the selection of countries, which you have in your pool and which you not have in your pool, imagine you started with 4. The other way of looking at it is also countries where you have high salaries and rich benefits. So we know, for instance, Switzerland is a country where the benefits are quite, let's say, in the market, in the private market. So quite high salaries, high premiums, same we can say for Norway, Canada the same, and there are many other countries where you have this combination of high salary and rich benefits. But also smaller countries could be interesting to consider for pooling, because it's smaller in contracts, in with smaller population, it's often the case that the margins on the contracts are higher. So the more margin for the insurer, the more margin also left if you have a good technical results for you as a multinational. Pools can generate losses as well as they can make profits, of course. Earlier explained, there's no risk for you as a multinational company. Depending on the type of pool, the loss will be brought forward or will be waived if there's a kind of protection mechanism in place. What we know is that you must be careful with putting US benefits in the pool for several reasons. And why working on expanding a pool, if you started already a natural pool, the reason is that larger pools are more stable and more efficient and more profitable. So it's always good to look at possibilities to expand the business you have already in your pool. Also an advantage could be in many developing countries that you have more, let's say, better or more flexible underwriting conditions. So for instance, instead of a 200,000 cap for acceptance, this could be even $1 million if you are in a pool with your contract. So this is also important to share with your local management. There could be practical advantages to them as well. Last but not least, one pool is no pool. Maybe it is. Sometimes you're missing the size to start more pools, but if you have 2 pools, 3 pools, even for very large companies, you have something to choose, and it could be interesting to compare what's possible in what kind of risk fit in one pool or the other pool, or could it be of the size of the contract that could be better to put it in one pool or the other. You may have different systems, etc. So it's always good to consider if there are more possibilities than one pool with one network. And in the market, there are 5, 6, at least networks that can do the business for you with all the different products, solutions, and things. So the system is quite straightforward, but making the right selection could be a little bit more difficult. We already mentioned the value of a local knowledge in your management, but it's also important to have the local broker on the same page, that they know that starting a pool is not immediate threat, not at all, but it gives opportunities as well to win some other business and to collect more information, because if you have an operation in Singapore, it makes it easier also to work with one local broker, whereas you may have 3 or 4 because of acquisitions you did in the past. So bringing the local broker on board, have a conversation with him. We do it on a regular basis, also explaining to the local broker what's happening and what the information is useful. Then it helps also to strengthen the position and the pool. Talking about the pool, just it's an example on one page in the report. You see how it's built up, maybe not really visible on the screen, but you will get the slides afterwards when it will be more easier to read. On top you see some general information, the country, the number of lives, the line of business. Then you see the area where the premium is in, so the business coming in. In disability plans you also see that there's already a reserve built up, and from each premium something will go to the reserve. So to make the calculation right and to get the right consolidation, there's a lot of information here as well. So below you will see the local balance, which is the money that will be brought into the client's pool. You see that the cost savings, as said, it's very, very relevant, but also gives you a lot of management information. And management information helps you also to monitor and to have more grip on your risk. Because what you know for sure is that if you have more claims in the country, then the premiums will go up. And pooling also helps you to give a better insight in, okay, the premium is increasing, why is that? How many claims did we have? Of course, this is all with the background of safety on private and personal information. It's the larger picture you see. It's high-level information, but it gives you better grip on what's going on in a country, because there's even information that will often not be shared with your local management. So pooling helps you as well to better manage your risk. Pooling is also one of the cornerstones in global benefits management. It could be a step to next phase, and then you can think about global underwriting, or even putting business in your captive, for which is very relevant, being self-insured, to know your risk and to know what claims have been there in the past. So, in the end, conclusion: it's very interesting and subject worth to consider. Many people have lots of excuses for not doing a pooling project. It's not a priority relatively to other things. It competes with other strategic initiatives, or there's simple lack of information or control on what's on locally. But the ability to provide cost savings and information, it's really worth to think about it and to pick up the phone and give us a call. Back to Björn in Oslo.
Thank you, Ron, and to all of you, thank you for participating. I hope the time with us has been useful. And after the session now, you will see the contact information. So if you have questions or something you will discuss with us, please feel free to get in touch. Have a nice day.